Hey everyone, welcome back to Underdog Investor. Today we're diving into some big news from the dining world that's shaking up the scene. You all know Hooters, right? Famous for its wings and its, let's just say, memorable dining experience? Well, brace yourselves. Hooters is scaling down big time across the US. Let's unpack why some of these iconic spots are saying their goodbyes. As the economic winds howl, even well-loved brands like Hooters are struggling to keep their feathers unruffled. It's a tough climate out there, folks. Here's what's shaking up. First up, economic crunch time. Hooters is trimming down its nest due to rough economic winds. It's like biting into a spicy wing without your drink nearby. The rising costs of running a restaurant these days are tough to handle. They've had to close several spots in states like Florida and Texas, where you'd think wings would fly off the plates. But it's not all gloom. Despite these closures, Hooters isn't throwing in the towel, which brings us to our second point, brands still flying high. They're spreading their wings in other ways, like launching a line of frozen foods you can munch on at home. Plus, they're popping up new restaurants overseas. So while some doors are closing, others are swinging wide open. And third, price hikes on the menu. Eating out is costing more dough. The Bureau of Labor Statistics shows that your favorite meal out is getting pricier, which might be why some are skipping the dine-out experience. It's like choosing between a new pair of jeans or that juicy burger. Tough call, right? So what does this mean for investors? If you're keeping an eye on your investment menu, this shakeup at Hooters is a clear signal. The restaurant sector is volatile, influenced heavily by economic tides and changing consumer tastes. Brands that adapt by diversifying their offerings and expanding into new markets are looking tastier for future growth. But beware those dabbling in restaurant stocks. Remember, the sector is as unpredictable as last-minute dinner plans. Economic downturns, shifting dining habits towards home meals, and rising costs are all ingredients that can unsettle the pot. Just look at Starbucks, McDonald's, for example. They are having their own challenges so far this year. So keep a close watch on how brands are innovating to keep diners engaged. And just for a little food for thought, imagine if Starbucks and Hooters joined forces. Picture this, introducing Hooters Bucks, where your morning coffee is served with a double shot of espresso and a double dose of fun. A place where the signature smiles are as crucial as the robust coffee, ensuring every cup comes with a generous splash of spirited charm. Okay, I'm just kidding around. But imagine the buzz if that were true. Speaking of which, let's take a quick look at a hilarious take from a popular TV show, 2.5 Men, where Alan joked about the very idea of a Starbucks and Hooters merger with Charlie.
She has commitment issues.
That's too bad. Hey, what's that splattered all over your shirt?
Coffee and breast milk.
What happened? Did Starbucks merge with Hooters? Hooter Bucks. I'd like a double D-cup latte, please.
Pretty funny, right? While we're obviously not expecting Hooters Bucks to pop up anytime soon, it's fun to think about how different brands might combine their strengths, or in this case, their coffee and, well, their charm. It's all in good fun, folks. But seriously, keeping a keen eye on how traditional brands like Hooters and Starbucks pivot and adapt in these changing times can provide some valuable insights for anyone interested in the business of dining and entertainment. All right, let's wrap up for today. Thanks for tuning in to Underdog Investor. Don't forget to like, subscribe, and hit that notification bell so you don't miss out on any updates from us. Catch you next time.